Back. The chair now recognizes the gentleman from Kentucky, Mr. Barr, chairman of our Monetary Policy Subcommittee, for 5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, congratulations again on your confirmation. I appreciate your commitment in our conversations to transparency and your demonstration of that commitment to date to clearly communicate the Fed's monetary policy trajectory. You have noted on numerous occasions that the remaining slack that may exist in the labor market is at least in part attributable to stagnant wage growth. And in your confirmation hearing, a senator on the Banking Committee cited a 2016 Fed research paper concluding that corporate tax cuts do not translate into higher wages. But we have seen a wave of corporate announcements of bonuses and raises since the tax cuts were enacted. Specifically, over 4 million workers and counting have received over $3 billion in bonuses and raises during the last 8 weeks. And the Labor Department recently announced the largest increase in wages since the end of the recession. Based on these numbers, is the senator in question and are the Fed researchers that he cites, are they wrong, and have tax cuts in fact help increase wages, as your testimony indicates that wages should be increasing at a faster pace as a result of a more stimulative fiscal policy?
Thank you, Chairman Barr. It's very hard to trace through the effects of a change in tax policy into things like wage growth and the economy, but let me try. So if lower corporate taxes should lead to higher investment, and the effect is not easy to estimate, but you would think, and the studies find, that it should lead to higher investment. Higher investment should lead to higher productivity over time, and higher productivity should lead to higher wages over time. It's very hard to put your hands on exactly how much that would be, but higher productivity, of course, is very, very welcome and will be driven by higher investment.
And clearly, the wave of bonuses and raises and the announcements certainly suggest that there is upward pressure on wages as a result of these tax cuts. In a 2015 speech, you expressed concern that quantitative easing and unconventional monetary accommodation could fuel dangerous risk-taking. Specifically, you said, quote, "The current extended period of very low nominal rates calls for a high degree of vigilance," unquote. Can you elaborate, and what specific risks have been created that the Fed now has to watch?
Well, I do think this is a time when we need to be alert to buildup of either financial imbalances or to inflation building up. We don't really see those right now. I think I also said that in my 2015 speech. But if you look at the financial stability situation broadly, we do see some high asset prices. What we don't see is the buildup of leverage among households. We see the banking system and the financial system generally as being, very resilient. So I think the financial picture shows it at most modest risks.
If I could point out maybe a possible risk that's out there and have you react to it, that was created by the unconventional monetary policy. As you know, some have blamed the Fed for contributing to the 2008 financial crisis by producing an inverted yield curve, where short-term interest rates exceeded long-term rates. At the beginning of 2011, the spread between the 10-year and 2-year Treasury notes was almost 3%. But as of February of this year, that same spread has been whittled down to a mere 0.5%. And this is a 450% drop. Given a flattening yield curve and economic conditions that you concede call for raising the Fed funds rate, how will the Fed avoid another inverted yield curve? And are there any plans within the balance sheet normalization strategy to roll off longer-term assets more quickly to counteract that flattening yield curve?
Flattening of yield curves in the past has been a sort of a precursor of recessions, but largely because in many prior recessions, the Fed had to raise rates quickly to hold inflation down. That's not the situation we have now. It's very typical for the yield curve to flatten as short-term rates come up, as the economy strengthens, and I don't see a particularly large. There's always a risk of a recession at any given point in time. I don't see it as at all high at the moment.
I don't either, but it is a risk that normalization after this unprecedented unconventional policy is created. And to dovetail off of what the chairman's point was in terms of the roll-off strategy, it would be important if there are not enough maturing mortgage-backed securities that mature in order for the Fed to actually hit its monetary roll-off targets. And so to that end, to avoid an inverted yield curve, do you anticipate perhaps selling assets?
No, I think I certainly feel that our balance sheet normalization plan was carefully crafted, carefully rolled out, and the markets took it without much of a reaction. And I think I would have little inclination to change the general parameters of it.